What's up everyone, it's Scotty with MoneyVest. So in today's video, I wanted to break down the unemployment numbers that came out over the last Friday here. It was the first Friday of the month, and next week, of course, we've got the most important inflation numbers as well as the Fed meeting on June 12th, and they are both going to happen on the same day. And that's going to, of course, be very, very volatile. The market's reaction is going to be very interesting, and for that, I will be live to cover all of that. So again, if you enjoy this video and find it helpful, please make sure that you drop a like, subscribe to the channel if you're just joining us for the first time, and more importantly, if you want to get access to our MoneyVest platform, so link's going to be down below if you want to, of course, enroll and have the early access to the beta launch that we're going to happen in the first week of July. Link's going to be down below. You can get up to a 51% discount that's available for a limited time until, of course, the launch here, and you can lock that pricing in forever. So that's going to be locked for you for life, and you'll have access to all the additional tools and features and functionality that we're going to add over time. I think there's a limited spots. There's I think 3 or 4 spots left if you're interested in joining. For first starters, you're going to have access to the MoneyVest metrics, of course, broken down by different years. You can also visualize this over a period of time. We're going to be adding a charting and, sort of a visual functionality over here, just like how we have it on the fundamental analysis. So you'll be able to kind of visualize all the different metrics for the company and, of course, calculate your own intrinsic value using our discounted cash flows, using the discounted earnings multiple model as well. And, of course, more and more functionality will be added over time. You'll also be able to see the analyst estimates as well as the insider transactions, ratios, and a lot of other cool features as well. So link's going to be down below. We'll love to have you on board. So first things first, let's break down exactly what the numbers were. So for unemployment on Friday, we added a whopping 272,000 jobs in the month of May. That was way above the consensus expectations of 182,000. And yet the unemployment rate ticked up to 4%, right? So from 3.9 to 4% for the first time since January of 2022. So if you come over to the BLS website, and this is all publicly available data that you can also access, bls.gov, you come over to subjects, you go to national unemployment rate, and of course it'll tell us what the current unemployment rate is. As you can see, they were sitting at 4% as of May of 2024. But this is not really the number that I focus on. This is not the number that I kind of, look at first. I mean, yes, it's the headline number. That's exactly what everybody is focusing on. But what I like to focus on is more about the civilian unemployment itself, like how many people in the U.S. of the participating population is currently unemployed. And that number is sitting at 6.649 million. And you'll notice that number actually is up from 6.492 million. So if you do the math here, 6.649, that's in millions minus the actual number from previous month, 6,492,123, and we're looking at 157,000 people that now entered the unemployed pool in the U.S. economy. So despite us having 272,000 job gains, mostly coming from the government sector, private hospitality, and leisure, we still had 157,000 people added to the pool of unemployed persons. And that is a pretty significant chunk if you think about it, right? And if this is the number that I plug in, that's when we get this unemployment rate at 4%. Now, this is also the chart that gives us a very good understanding of how far we have come from the great inflations of the 1970s. And you'll notice that right now we're sitting at 4%. In the past, during times of recession, during times of distress, we've hit double digits at over 10% to as much as 14% during the pandemic, and dot-com bubble 6.2%. And every single time we've also hit double-digit unemployed persons rate, except for the dot-com bubble when we were at over 8.5 million unemployed persons. I asked all of you during the live stream, how many people you think need to be unemployed for this number to be over 6%? And that number is 10 million. So if I hit over 10 here, you'll notice that we are now dead at 6% unemployment rate. Now, the interesting thing is that the economy's changed since the great inflations. There's been a lot of changes. Of course, the population size has increased over time. So we were working with 226 million people back in 1970s, of which the eligible workers were 182 million. people who were above the age of 16 and were looking for jobs. And then, of course, now we are looking at 266 eligible workers, 266 million eligible workers that are above the age of 16 compared to 182 million back in 1970s. We've seen a gain of about 84 million people added to the workforce in the last 54 years or so, to over 266 million. So of course, the economy landscape, the jobs, everything has changed. And now the same number, if I plug in back in dot-com bubbles, let's say back in 2000, so 24 years ago, 6.65 would already put us at over 4.85, almost at 5% unemployment, not to mention at 6.65 back in 1970. So 54 years ago would already be over 6% unemployment rate because of the number of people that's unemployed. So the point that I'm trying to make here is that yes, even though unemployment rate in itself seems pretty low and reasonable at 4%, I think it's really important for us to keep in mind that as a percentage of the overall population, yes, it's low, but it's still over 6.5, almost 7 million people that are still unemployed and looking for jobs over in the US. That's still pretty staggering number. Now, this right here is another really important piece of information that I shared in one of my previous videos. I specifically talked about how this research from Wolf and Barger pointed out the unemployment starting to tick higher, and the chart below shows that the unemployment rate has crossed above its 2-year moving average, represented in the black and red. And of course, every time it's happened the last three times, 2001, 2007, 2020, every single time that's been preceding a major recession that's started. So you can see that we're already at 4%, and that is a very, very clear indicator that unemployment is indeed ticking higher after hitting a 54-year low at 3.4%, of course, at the end of 2023, and now we're starting to move up. And every single time it's crossed above its 2-year moving average, we've seen a recession. And every time we've seen a longer duration of the inversion of the yield curve, of course, that's also led to a more severe recession in the past. Again, depending on the number of days, that is what the severity of that recession means for the U.S. economy. Of course, back in 1970s, 2008, we saw the inversion of well over 500 days, and the markets fell on average between 45 and 55%. So I think it's really, really important for us to be careful, be cautious here. This was from Heather Long on Twitter. Just in another big jobs report, the U.S. economy added 272,000 jobs in the month of May, blowing past expectations of 190,000. People keep getting jobs, especially in healthcare, government, and hospitality. Unemployment rate of 4%. This is the first time the 4% level has been hit since January. And this is from Charlie Bellew as well, also suggesting for a potential recession in the U.S. economy when you consider that the unemployment rate is now 0.6% above the cycle low from April 2023, which was at 3.4%. Historically, that meant that 0.6% move higher has occurred near the start of a recession as well. Every single time you've seen that happen, every time you've seen a 0.6% increase from the cycle low, that's led to a recession in 2020, 2007, 2001, 1990, 1981, 1980, 1973, 1969, 1960, so on and so forth. Every single time it's led to a recession. So is this time going to be any different? We're going to have to find out. The U.S. unemployment rate now above 4% in May, the highest level since January of 2022. 29% of households have jobs but struggle to cover basic needs. They are one emergency away from poverty, is also a report from one of the experts. So the bottom line is that I strongly feel this is what's actually going on in the economy, which unfortunately, and I hate to say this, seems a little bit more of a ticking time bomb in the U.S. And the reason I say this is because a lot of the spending, a lot of the economic growth, a lot of the earnings momentum that a lot of these companies are witnessing is happening on the back of one word, and that one word is debt. Credit card debt is at an all-time high. Credit on mortgages, on auto loans, on debt in general is ballooning in the U.S., unfortunately. And even though we're seeing an unemployment rate that's really low at 4%, number one, it's ticking higher, so it is starting to move up. Number two, unemployed persons is increasing, right? So 157,000 unemployed persons now, month over month, is a pretty high number. And if that continues to increase, so let's say 10 million, and now we're getting up to over 6% unemployment, and that is going to be troublesome for the economy, right? So that's going to be a lot of people unemployed in the U.S. It's another 3 million entering the unemployed workforce looking for jobs in the U.S. So that's a pretty big deal. Number three, delinquencies, right? Delinquencies is on the rise. It happens in a way that the first credit card delinquencies begin, then auto loans, then personal loans, then mortgages. It's kind of like the most risky type of debt delinquencies are the first. The least risky, which is mortgages, they're backed by the collateral, which is the house itself, are the last ones to be delinquent on. So that's the ladder. That's the chain of delinquencies that follows. And right now we're starting to see, again, credit card delinquencies on the rise, starting to increase. So I think it's really, really important that we prepare for a recession. Not saying there's going to be one, but I think it's really important to prepare for one because of the inversion of the yield curve. Now it's starting to uninvert, and every time we've seen a recession, it's happened on the uninversion, not on the inversion itself, but on the way back up. And number two is, of course, we're seeing unemployment tick higher, and there's been a lot of data suggesting that every time it's crossed over its 2-year moving average, or every time it's 0.6% higher than its cycle low, there's been, unfortunately, economic dips or economic contractions in the U.S. Now, one more thing is what I'm going to mention and what I'm going to leave you with is just because there is a recession does not mean that it's not a buying opportunity. I want to be very clear that I think we need to be ready from a standpoint of deploying cash and being more aggressive and dollar cost averaging, because every recession is a buying opportunity. Every dip, every correction, every bear market, every crash is a buying opportunity. So get your cash ready, because if and when there is a market pullback, of course, next week is going to be very important on the back of Jerome Powell, FOMC, SEP, and inflation. So we'll take a look at the market's reaction. I'll be live during that time. But like I said, it's all going to be a buying opportunity for us. So hope you all enjoyed this video, found it helpful. Make sure that you drop a like, and also don't forget, subscribe to the channel, and also do join our Discord and our Patreon. You'll have early access to the entire platform. In the first week of July, you can give us feedback. We're building something amazing for all of you. So there is a big 51% discount. You can lock this pricing in forever with about 3-4 spots left if you're interested in joining. Link's going to be down below. So always happy investing. I'll see you all in the next video.